Welcome to FX Signal Team. Today, we are going to start 12th chapter of part 2. The main topic of this chapter is money management, position sizing, risk reward and risk control. Let's start. The most important piece of the pie that many traders like to ignore and that many educators don't talk much about: money management. It may not be super exciting on the surface, but once you understand the significance of it and how it can affect your emotions as you trade, you will realize it really is the difference between becoming a successful or profitable trader and just being another failed trader. I want to make it very clear right now. You need to read this whole section very closely and probably multiple times. If you skip this section, or think you will come back to it later, everything else you have learned to this point is basically worthless. A trader cannot be successful if he or she is not focused on managing their risk and reward properly. Most traders focus way too much on entry signals, indicators, magic systems and a bunch of other feel-good stuff that is a complete waste of their time, money and lives. Do not be like them, be different. Listen to what I'm talking about because I have been at this for over 14 years, and I have helped thousands of traders just like you. So, I will see this right here and now. You have been warned. If you skip this section or do not study it thoroughly, you will probably fail as a trader. Take the time to learn this stuff and jam into your brain. It's critical. Let me make something else very clear before we dive into this section on money management. Risk and return is to be thought of as dollars risked or dollars earned. It is not to be thought of as percentages or pips, because pips gained or lost only tells half the story. How many lots you trade will dramatically affect your dollars risked or earned, thus no trader should ever measure returns as just pips or percentages. This is why traders have issues trading with a large stop loss. They are thinking in pips, not dollars risked, a big mistake for novice traders. The following information is dedicated to money management and tells the truth about how a pro trader thinks about capital risk over reward and trade management. Let's begin with position sizing. Why position sizing is more important than pips risked. Position sizing is a tool that is very often ignored, or that many traders simply do not know anything about. Position sizing is very important in forex trading, and anyone actively trading the forex market needs to fully understand why it is important and how powerful it can be in regards to helping you manage your emotions. It is far more important to measure your risk on each trade you take in dollar amount risked as compared to pips risked. Many novice and experienced traders alike mistakenly assume that wider stop losses will require them to take on bigger dollar risks, and that smaller stop losses will let them incur smaller dollar losses. This is a false assumption and is a big reason why you need to understand the role that position sizing can play in your forex trading success. The forex market offers the most flexibility in position sizing. If you are one of the many forex traders who has convinced themselves that position sizing and risk management is not important because your trading system or method is just so accurate, or because you are feeling like your recent winning streak will never end, the forex market offers extreme flexibility in position sizing. This is one of the biggest advantages that forex traders have over people who trade stocks or commodities. One standard forex currency lot is around $10 per pip, depending on what pair you are trading. Almost all forex brokers now offer mini lots as the default position size. The smallest value for a mini lot is approximately $1 per pip, and once again this depends on the currency pair you are trading in. Many forex brokers now even offer micro lots. These effectively allow you to trade as small of a position size as 1 penny per pip. However, most brokers only go down to 10 cents per pip. This extreme flexibility in position sizing allows people to open a forex trading account with as little as $250 and still have a fighting chance at building it up. Compared to commodity futures or stocks, the flexibility of position sizing that forex offers is not even close. A quick lesson on position sizing. Position size is essentially the number of lots you are trading per trade, whether they are standard, mini, or micro lots. For example, if you are trading 2 mini lots of GBP USD, then this means you have either bought or sold $20,000 worth of US dollars, and depending on whether or not the exchange rate between the British pound and US dollar moves in your favor, you will win or lose an amount of money equal to $2 per pip, X number of pips moved. So if you made 100 pips, you would have profited $200. So that we can understand the math behind this, we will look at it from a different angle. If GBP USD moved from 1.5600 down to 1.5500, that would be a 100 pip move, which is actually equal to a 1 cent price difference in the exchange rate of GBP USD. So, we now take 0.0100 into 20,000 and this equals $200. To break this all down, one standard lot allows you to control approximately $100,000 worth of currency and is worth about $10 per pip. One mini lot lets you control about $10,000 and is equal to $1 per pip. One micro lot lets you control about $1,000 and is equal to about 0.10 cents per pip. Thus, if you open a standard lot trading account and elect to trade mini lots, one mini lot would be 0.10 standard lots, 5 mini lots would be 0.50 standard lots, etc. If you open a mini lot trading account and elect to trade micro lots, then one micro lot would be 0.10 mini lots, and 5 micro lots would be 0.50 mini lots, etc. So in conclusion, the actual size of your position depends on whether you have a standard or mini account and how many lots you are trading. Micro lots are generally a function of the mini account and most brokers don't offer strictly micro accounts. This information is important to know so that you can build your understanding of position sizing on a solid fundamental base. Position sizing and the risk-to-reward ratio. It is absolutely paramount to your consistent profitability in the forex market that you understand the importance of the risk-to-reward ratio and how it relates to position sizing, Before entering any trade, you need to know the exact dollar amount you want to risk and the exact reward you think you can make on the trade. At no point should you ever take a profit that is less than the amount you risked on the trade. You will see why this is so important in a minute. Once you have determined the dollar amount you want to risk, then you adjust your position size to meet this amount. If you are trading micro lots and want to risk $50 on a trade with a 100 pip stop loss, then your position size will be 0.5. Remember, 5 micro lots would be 1/2 of one mini lot. 0.5 into 100 equals $50. So you would have a position size of 0.5 mini lots, risking $50 with a per pip value of 0.50 cents. Risk to reward ratio is very important to understand. If you risk $100 on a trade and your target is set at $200, then you are doubling the amount you risked if you win. This is a risk-to-reward ratio of 1 to 2. It is important to realize here that with a risk-to-reward of 1 to 2 you can lose on over 50% of your trades and still make money over time. In fact, you could lose 65% of your trades with a risk-to-reward of 1 to 2 and still make money. Over a series of 10 trades, if you win only 35% of them with a risk-to-reward of 1 to 2, you would profit $50 if you risked $100 per trade. Here is where the power of the risk-to-reward ratio comes into play. Many traders erroneously believe that they must win a very high percentage of their trades to make money in the market. The fact is that winning percentage is nearly irrelevant in whether or not you make money over the long term. What is important is if you are taking advantage of the risk-to-reward ratio. For example, if you maintain returns of 3 times the amount you risk, your risk-to-reward ratio is 1 to 3. This effectively means you can lose 7 out of 10 trades and still make money. At $100 risk, you would lose $700 on 10 trades, but you would make $900 off your 3 winning trades because your risk-to-reward was 1-3. Thus you profit $200 even though you lost 70% of the time. You should be starting to see how this works now, why having a high winning percentage is not relevant, and why it is crucial that you maintain a risk-to-reward of 1 to 2 or higher for every trade you take. The fact is, it is very difficult to win more than 50% of your trades in any market. Most professional traders only win about 50% of the time at best over the long run, but they understand the power of the risk-to-reward ratio, so they still are able to make very good money. Risk is measured in dollars, not pips. Position sizing allows you to adjust the number of lots you trade to meet the amount of money you want to risk per trade. This allows you to use wider stops but still maintain your desired dollar risk. Many forex traders mistakenly believe that a wider stop loss will mean a bigger risk. If your desired risk amount is $100, but you want to place your stop at a level that is 200 pips from your entry, then you simply adjust your position size down to meet the dollar amount. For example, let's say you are trading many lots of GBP USD. A $100 risk with a 200 pips stop loss would need a position size of 0.5 or 5 microlots. You would be trading 1/2 of 1 mini lot, which would be 0.50 cents per pip. 0.50 into 200 equals $100. So, just because you increase your stop loss distance does not mean you need to increase your risk. Many people will adjust their stops but not adjust their position size. This is a major error and is a main cause of blown-out trading accounts. If you start out risking $100 with a 100 pip stop, but then decide to move your stop up another 100 pips, you have just increased your risk to $200. This is a cardinal sin in trading and one you cannot afford to commit. You need to define your risk in dollars before entering the trade, and then adjust your position size accordingly to meet the desired stop loss distance, so as to maintain the desired dollar amount risked. Similarly, many traders think that a smaller stop loss means a smaller dollar risk. This is not always the case, however. Position sizing will explain this. If Joe Trader has a stop loss of 50 pips but is trading $5 per pip, 5 mini lots, then his risk is $250 on the trade. If Susie Piper has a stop loss of 100 pips but is trading $2 per pip, then her risk is only $200 on the trade. As we can see, a smaller stop loss does not necessarily mean a smaller risk. Position sizing determines your dollar risk on the trade, not pips. So from these examples, The take-home lesson is that risk should always be measured in dollar amount risked, not pips risked, because the size of your position is what determines your risk, not the size of your pips. Build your risk management plan around position sizing and risk-to-reward ratios. Traders often hear that they should have a risk management plan, but oftentimes the idea of it seems somewhat abstract, so they don't give it much more thought, or they just think, consciously or subconsciously, that they are so good at trading they don't need a clearly defined risk management plan. The bottom line here is that you absolutely must have a well thought out and clearly defined risk management plan if you truly want to have a fighting chance at making money in the forex market. There is no way around this fact. You can get lucky for a while and make money without managing your risk, but any seasoned forex trader will tell you that luck will only run for so long, and the habit of not managing your risk will always come back to bite you, each time harder than the last. Risk management does not need to be complicated to understand or difficult to implement. Most trading books or trading websites don't really give any specifics on risk management plans. They just briefly state the importance of them and then move on to talk about some bogus lagging indicator or other nonsense. Here is what you need to include, in order, at the very minimum, in your forex risk management plan. Determine your risk-to-reward ratio on the trade before entering. Based on the setup you are using to enter, where is your stop loss and where is your profit target? If you cannot get a reward that at least doubles the amount you risk, then don't take the trade. A risk-to-reward of less than 1:2 is not sustainable over time, because it is very difficult to maintain a winning percentage high enough to maintain profitability at a risk-to-reward ratio below 1:2. Ideally, you should aim for a risk-to-reward of 1:2, 1:3, or 1:4, as these are the ratios with the highest probability of getting hit before any significant retracement occurs. Adjust your position size to maintain desired risk amount. Once you have figured out your risk-to-reward ratio on the trade, you need to implement the proper position size to make sure you maintain your predefined dollar risk. The point here is that not all setups are created equal. There is inherently some amount of discretion in any trading method. So depending on the quality of the setup, you may decide to risk more or less than usual. Whatever amount you decide on, you will need to make sure you adjust the position size to meet the desired stop-loss level, so as to maintain your dollar risk. Realize that dollar amount risked per trade is somewhat discretionary. Forex trading is more art than science. Conditions can be volatile or quiet, trending or consolidating, or any combination of the four. Any trading method will inherently provide some degree of discretion, unless you are trading a robot system, which never work in the long run. As such, it may be in your interest to risk slightly more or less depending on the quality of the setup at hand. This is where screen time and experience come into play. A general rule of thumb is to risk less than 3% per trade, if you are a beginning trader who doesn't have much experience with the method being used. As you grow in experience and screen time, you can risk more or less depending on if you think conditions call for it. This is a very advanced method though, and traders who do not have years of experience under their belt should never risk more than 3% per trade. Just keep in mind that risking too much on any one trade will very likely impact your psychological stability and could cause you to spiral out of control and commit a whole host of emotionally charged trading mistakes. Managing your capital. Managing your trading capital is really about preserving it. You want to preserve your capital for the obvious or confluent high probability price action setups. This way you maximize your profit potential. Where most traders go wrong is that they abuse and overuse their trading capital. They quickly give back profits mostly because they don't have the patience to stay out of the market and wait for another high-quality price action signal to form. You need to think of your trading capital as real money, not just numbers on your computer screen. You may want to withdraw some profits each month and hold the cold hard cash in your hands and realize that you can use it to pay bills or buy things. There's often a disconnect between the money you see in your trading account online and how real it seems to you. Minimize losses. The number one reason why most new currency traders don't trade for very long is because they fail to keep losses small. When you lose money in trading, you have less capital to work with. Therefore, to make back what you lost, you have to earn a substantially higher percentage return than what you lost. Keep your position sizes small initially and apply stop losses. We are not trading forex to gamble. It is paramount that you protect your trading balance. If you lose 25% of the money in your account, you should stop trading live and go back to demo trading until you trade profitably. Aim for consistency in risk, especially early on in your career. Traders often make the mistake of cranking up their dollar risk per trade after a few winning trades. Doubling or tripling your risk too soon is a huge mistake many traders make. Especially early on in your trading career, you need to gain experience and learn your trading strategy until you have mastered it. Maintaining a consistent risk per trade is very important when in this stage and while building your account up. You can do something like setting goals for yourself, and when they are achieved, then you can consider increasing your dollar's risk. For example, you might say that you will double your dollars risked per trade once you have doubled your initial trading account deposit. So, if you started with a $2,000 account and were risking say $100 per trade, then you would wait until you grew your account to $4,000, whilst risking $100 per trade, and then you could increase your risk to maybe $150 or $200 per trade. You have to decide what is best for you and what you're most comfortable with. Just be sure that you maintain a constant per trade risk until you hit certain milestones in your account. This will help keep your emotions in check, and will teach you patience and will also help keep your losses contained, all of which are very important for a beginning trader to learn. By the time you have doubled your account or tripled it, you will likely be ready to handle the increase in per trade risk. Protective stop losses. All good trading methodologies use stop losses. A protective stop loss is in order to exit a long or short position should prices move against you to a specified price. The stop loss ensures against an unusually large loss and has to be used in one way or another. An initial stop loss can be placed with your order on the trading platform. The trade will be closed automatically if the stop loss is hit. This type of stop loss will allow you to walk away from the computer to watch TV, talk to people, or leave the building. It is the ideal stop and is used by most successful traders. You can still close the trade manually before price reaches your target if the trade doesn't look like it will go your way. If you buy, go long, your stop loss will be below the market. If you sell, go short, your stop should be placed above the market. Mental stop loss or time stops. This is the point you choose for an exit if the trade does everything possible to do the opposite to what you expected. This does not mean to panic or succumb to emotions. The best example would be if you enter a trade, and for the next 5 days the market goes up and down in a narrow range, voiding the initial trade setup. It might be that you use a mental stop loss and also use a normal stop loss as a backup just in case things go wrong. Naturally, the broker cannot hit a mental stop because he cannot see it. Trailing stop loss. Trailing stops are not essential. This involves the trader moving the stop loss as the trade moves in his favor. For example, in a long trade, the EUR/USD moves up steadily from the entry at 1.2300 to touch 1.2500. The trader will trail his stop loss to 1.2300 to lock in break even, allowing the open profit to run. Emergency stop loss. If you are trading very short-term, without a stop loss. This emergency stop loss is a standard stop loss order, placed 100 pips below or above your entry price to protect your capital, in case you have a computer failure, loss of internet service, sudden unexpected news event spike, etc. Let's hope you never trade in this manner. Risk over reward. If you have learned part 1 of the course already, you know we covered the basics of risk over reward pretty good there. But I just wanted to get into more of the theory side of it for a bit in this section. Let's start out with a quick refresher. A positive risk-reward ratio of 1 to 3 would mean we would be risking, say, 50 pips to make 150 pips. This is better than a negative reward ratio of 2 to 1, where we could risk 50 pips to make 25 pips. Winning percentage is irrelevant when we incorporate a solid risk-reward scenario in our trading. If our profits are larger than our losses, over time, our account should grow. An important sentence above is, winning percentage is irrelevant when we incorporate a solid risk-reward scenario in our trading. Maybe that is a bit of an exaggeration, because you do need to win some of your trades, so it's not irrelevant, but what I am trying to say is that it's not very important, certainly not as much as everyone thinks. Consider that if you have a 1:3 risk-reward ratio on all your trades, and you win just 6 trades out of every 20, you would still make money. Let's say you risk $100 per trade. If you have 6 winners at 3 times your risk, you would make $1,800 profit. If you then lost the other 14 trades out of 20, you would only have lost $1,400, since your risk is 1R. Thus, you made $400 profit and you lost 60% of your trades. You had a measly 30% winning percentage. Now, you should be able to understand the power of risk-reward. If you focus on taking only high-probability trade setups, you should be able to make money over time if you're aiming for risk-rewards of around 1-2 or more. A skilled and experienced price action trader with a lot of patience to wait for only the most obvious setups should easily be able to win at least 50% of his or her trades. When you combine that with a strong risk-reward of 1-2 or more per trade, you can easily see how the profits would start adding up. However, the key here is having patience. There may only be a few good setups per month that lead to big moves, but that's all you really need. Even if your account is small, just worry about trading well and don't worry about taking a lot of trades each month. If you build a small account up over a 6-month to 1-year period, that is a real asset and demonstration of skill that any serious investor would stand up and take note of, and potentially fund you. Just remember that being a skilled and profitable trader is the goal, not making a lot of money right away. The money will attract itself to you over time as you demonstrate consistent patience and discipline. Conclusion. The 3 M's of trading are mind, money management, and method. Without mastery of one of the M's, the other 2 won't matter too much. They are all interconnected and all depend on each other. If your money management is off, it will negatively impact your trading mindset, which will in turn cause you to deviate from your method and overtrade it. If your mindset is off, you will not have the focus or discipline to stick to proper money management and risk control, which will result in you risking too much and taking too big of losses and eventually blowing out your account. If you have not mastered the price action method I have taught you here, and learn to wait patiently for the most obvious or confluent setups like the examples discussed in the course, it won't much matter if your mind and money management is right, because you'll be wasting them on low probability trades. So, the point is, do not underestimate the power and necessity of money management and proper risk control. I say this because many traders overly focus on their method and pay little attention to managing risk and trading capital, and it inevitably leads to their eventual failure. Our next chapter will be trading psychology, mastering the emotions of trading.